The U.S. stock market is currently closed. As of the closing bell on Wednesday, October 15, 2025, shares of Nuburu, trading under the ticker symbol BURU, ended the session at $0.152, marking a decline of 3.8% for the day. Now, a price point like that immediately brings a certain type of investor to the table. The thinking is that at fractions of a dollar, the potential for a massive percentage gain on even a small move is enormous. The expectation is that you found a ground floor opportunity in a high-tech company before the rest of the market catches on. But the reality of what that sub-20-cent price represents is a narrative of immense distress, significant operational hurdles, and a desperate fight for survival, a story far more complex than a simple glance at a Robinhood stock trading app would suggest. This isn't a story about getting in early, it's a story about understanding the immense risk the market has already priced in. Let's be clear, the surface-level narrative for Nuburu is incredibly appealing. It's built on a foundation of proprietary blue laser technology. The common belief is that since blue light is more effectively absorbed by conductive metals like copper and gold, Nuburu holds a key to more efficient manufacturing in critical growth sectors, especially electric vehicle battery production. You hear copper welding for EV batteries, and your mind immediately draws a parallel to the kind of enabling technology that made Nvidia stock a titan in artificial intelligence. The expectation is that this is a classic pick-and-shovel play on a booming industry. But the market is a discounting mechanism, and a stock price hovering just above 15 cents is not the market failing to see potential, it's the market screaming that the potential is overshadowed by severe present-day problems. The disconnect between the exciting technology and the brutal financial reality is where astute analysis begins, and where many retail investors, perhaps doing some self-investing for the first time, get burned. Looking at the recent trading activity in BURU provides a clear window into its current state. The daily volume is often erratic. On some days, it's perilously thin, with just a few 100,000 shares changing hands, making the stock highly illiquid and susceptible to sharp moves on small orders. On other days, you'll see a sudden spike into the millions of shares, usually driven by a press release or speculative chatter, which inevitably fades within a couple of sessions. This isn't the steady accumulation you see in a healthy growth stock like Apple stock. It's the frenetic, news-driven trading characteristic of a penny stock. For anyone using a sophisticated platform like the one offered by Interactive Brokers, the Level 2 data would likely show wide bid-ask spreads, further highlighting the difficulty in executing trades at a favorable price. This kind of volatility is a nightmare for automated platforms like Schwab Intelligent Portfolios, which are designed to avoid precisely this type of unstable asset. The stock's movement is less about its fundamental prospects and more about day-to-day sentiment and the constant looming threat of delisting from the NYSE American Exchange, which has minimum price requirements that BURU is consistently violating. The company has already executed a reverse stock price to regain compliance in the past, a move that consolidates shares to boost the price but does nothing to fix the underlying business issues, and often precedes further declines. The financial reality is where the expectation of a high-tech growth story completely falls apart. In their recent quarterly filings, Nuburu has demonstrated a pattern that is all too common with post-SPAC, pre-profitability companies. We're talking about quarterly revenues that are minimal, often in the low single-digit millions, while the net losses are substantially larger. The cash burn is the single most important metric to watch here. This is a company that is spending significantly more than it makes, funding its operations by depleting the cash on its balance sheet. This leads to a critical dilemma. It must either raise more capital or cut expenses so drastically that its growth prospects wither. Raising capital at a stock price of $1.5 is incredibly dilutive to existing shareholders. Any new financing, whether through a secondary offering or convertible notes, means issuing a massive massive number of new shares, which puts further downward pressure on the already low stock price. It's a vicious cycle, and it's a key reason why many investors who use full-service options like Fidelity Wealth Management are advised to steer clear of such speculative ventures in their core portfolios. The risk profile is simply too high.